Hey everyone, hope you all are doing well. So I've been investing in the stock market for 8 plus years now. And in that journey, I've made plenty of silly mistakes. But I don't want you to make the same mistakes. And so in today's video, I'm going to share with you 7 beginner mistakes that you must avoid in any circumstance. The first mistake is investing more than 10% of your money in one singular stock. So a few years back, I had a corpus of 24 lakhs wherein I had invested 8 lakhs in HUL, 8 lakhs in Dabur Limited and 8 lakhs in Divi's Labs. Now I was so naive that I was thinking I would make great returns because all these stocks would perform so well. But little did I know that I was actually risking my capital by investing so much money in just few stocks. But later on I realized that even if one of my stocks did not perform well, I would end up losing the gains on 33% of my capital. When I understood the concept of protecting your money, diversification and risk mitigation, I made it a point to not invest more than 10% of my money in one singular stock. The second mistake is investing in low quality debt funds in the anticipation of high assured returns. The thing is, I used to have the notion that low duration debt funds are completely risk-free. But a few years back, when I invested in Franklin Ultra Short Term Bond Fund, it completely changed my perspective. So what had happened was that Franklin Ultra Short Term Bond Fund had invested in a lot of low rated debt securities, and when the maturity of these securities came, it was unable to retrieve the money from those companies. So eventually, when this news spread, a lot of mutual fund investors started redeeming their units, but since the mutual fund scheme did not have the funds, it started facing a cash crunch. And so the Supreme Court had no option but to suspend this scheme. Now, since the size of the fund was more than 24,000 crores, the mutual fund house was given a time of a few months to pay off the amount to the mutual fund holders in tranches. I did not get any returns from the fund, but at least I got all of my principal amount back and the learning that I should always invest in debt funds that invest in high quality debt securities. The third mistake is relying on past performance to project future growth. So as I told you, I had invested in Dabur Limited a few years back. If you see the returns of Dabur Limited between 2016 and 2021, it had given an absolute return of 120%, which translates to a CAGR return of more than 17%. But in the last 5 years, the returns of Dabur Limited have been a negative 3%. So this clearly shows you that relying on past performance can really break the deal, and it can actually make you invest in a stock at its all-time high and you might end up not making any gains out of it. The fourth mistake is being invested in losing stocks for way too long, even if better opportunities are available. I've seen the portfolio of a lot of people wherein they've stayed invested in losing stocks for multiple years. When I ask them the question, why is that so? They simply reply by saying that the stocks will eventually recover in the long term. Then my follow-up question to them is, didn't you find any better investment opportunities in this period? They simply say yes, they did find, and actually they sold their winning stocks to invest in those opportunities. The thing is, people don't realize that in the long term, if you keep on holding your losing stocks and selling your winning stocks, then eventually your overall portfolio's return may become negative. This simply happens because of the natural human instinct of loss aversion, wherein we don't want to deal with the feeling of booking a loss. In my recent video on wires and cables industry, I discussed how a good buying opportunity is available for investors. And so I'd actually invested in Polycab and KEA Industries by selling one of my losing stocks. The fifth mistake is finding small cap stocks to invest in. A lot of people think that by investing in small cap stocks, they will grow their portfolio fast and thereafter they will invest in safer stocks to preserve their capital. But the thing is, by investing in small cap stocks, you end up taking a lot of risk. Though there are chances that you might get a huge amount of return, there are also equivalent chances that you might end up losing all of your money. I'm not saying that you shouldn't invest in small cap stocks, but it is better to leave the investment decisions to a qualified fund manager who manages a small cap mutual fund. The sixth mistake is investing in stocks you don't understand. Many a times people invest in stocks by just looking at the technical charts. While technical charts may be helpful to scalpers or day traders, it is not helpful to people who want to invest in a stock for the long term. For long-term investors, it is a must to do fundamental analysis of the stock and also read industry reports as well as the annual report of the company and continuously keep a track on changes that happen within the industry. You'll be able to make good investment decisions only if you are fully informed. Last but not the least, the seventh mistake is prioritizing passive returns from investments over active income. For most people out there, the biggest wealth builder is their active income. For me personally, I also run a battery retail business in Bhopal, which allows me to earn a regular income as well as invest in stocks. For you, it can be income from your job that allows you to sustain your lifestyle and also invest in stocks. I would say that only if you have accumulated a corpus of 50 times your active annual income, you can start prioritizing passive return from investments. But till then, always prioritize your active income over investing. I hope you were able to garner useful insights from investing mistakes I made in 8 years of my investing journey. Thank you so much for watching. Like the video, hit that subscribe button and stay tuned for my next video.